Imagine this. You're sitting in a dimly lit room, the glow of multiple screens flickering across your face like distant lightning. Your trading platform is open, charts pulsing with the heartbeat of the markets. You've spent weeks, maybe months, crafting what you believe is the perfect strategy. It's simple, elegant, backed by data that screams success. A trend following system, perhaps, or a mean reversion play on volatility spikes. You've run the numbers, it has an edge. But now, as the first real trade unfolds, something stirs inside you. Doubt. That whisper in your ear, this isn't right. The market's different today. Just tweak it a little. Exit early. Add to the loser. And before you know it, you've broken your own rules again. This isn't a failure of intelligence. It's not a flaw in your strategy. It's the human condition clashing head on with the probabilistic chaos of trading. Welcome to the episode where we dive deep into the heart of what separates the consistent winners from the rest. Conviction. Not blind faith, but the kind of unshakable belief forged in the fires of preparation, experience, and self-awareness. Today, we're talking about how to develop that conviction in your trading strategy and stay consistent, no matter how loud the inner voices scream, no matter how brutal the drawdowns get. This is a journey, not a checklist. And by the end of these 40 minutes, you'll have the map to build your own fortress of discipline. Let's kick things off with a story that cuts right to the core of this paradox. Picture the year 1983. Chicago's skyline is a jagged silhouette against a stormy sky. And in a modest office downtown, two trading titans are locked in a heated debate. Richard Dennis, the prince of commodities, fresh off turning a measly $1,600 into $200 million through sheer trend-chasing wizardry. His partner, William Eckhart, a quant savant who believes trading genius is born, not made. Dennis fires back. Trading is a skill. Teach it right and anyone can learn. To prove it, Dennis doesn't just argue, he experiments. He places an ad in the Wall Street Journal. Wanted trading apprentices, no experience necessary. Over 1,000 responses flood in. He whittles it down to 23 wide-eyed novices, accountants, teachers, even a security guard, and flies them to the Windy City. For 2 grueling weeks, Dennis doesn't hold back. He hands them a complete mechanical system, entry signals based on breakout channels, exit rules tied to trailing stops, position sizing scaled to volatility, risk management capped at 2% per trade. It's all math, no mysticism. Then the kicker, he seeds each with between $500,000 and $2 million of his own money. Go trade. The turtles, as they became known, exploded onto the scene. Over 5 years, they raked in $175 million collectively. Jerry Parker, one of the standouts, spun his turtle training into a hedge fund managing billions. The system worked spectacularly, but here's the gut punch most histories gloss over. Not all turtles thrived. Some stuck to the script like glue and minted fortunes. Others, they tinkered, they second-guessed. They bailed during the inevitable losing streaks, convinced the magic had evaporated. These weren't rookies fumbling in the dark. They were handpicked by Dennis, mentored daily, armed with a strategy proven across decades of market carnage. And still, conviction crumbled. Why? Because rules on paper are easy. Rules in the heat of live fire? That's where the mind betrays you. This is the trader's eternal riddle. Why do we sabotage our own success? Why, when the data screams, stay the course, does every neuron fire abort mission? To unpack this, we need to peer into the wiring of our brains, the ancient hardware that's spectacularly ill-suited for modern markets. Our ancestors didn't evolve to bet on 55% win rate edges. They survived saber-toothed tigers by reacting fast, not by averaging down on probabilistic hunts. Fast forward to today. Your trading desk is no savannah, but your amygdala, the brain's panic button, doesn't know the difference. Picture a trade going south. Your stop loss is 200 pips away, but it's already down 150. Heart pounding, palms slick, cortisol flooding your system like a bad espresso shot. Neuroimaging studies from places like the Yale School of Management show this stress response hijacks your prefrontal cortex, the rational command center. Decision making? Compromised. What feels like a brilliant insight. The Fed's pivoting, I need to reverse, is just your lizard brain grasping for control. It's not weakness, it's evolution's leftover code, screaming danger at a paper cut. Layer on recency bias, that sneaky thief of perspective. Our brains love stories, not statistics. 3 losses in a row? Suddenly, your system's a dud, even if backtests show it's normal as breathing. A 2021 study in the Journal of Behavioral Finance tracked 500 retail traders and found deviation rates spiked 4.1 times after clustered losses. Flip side, a hot streak breeds overconfidence. You juice position sizes, chase FOMO entries, and boom, your next drawdown hits like a freight train. It's the market's cruel joke. The very variance that makes trading profitable also tests your faith to the breaking point. Then there's action bias, the itch to do something, anything, when stillness feels like surrender. Behavioral economists at Harvard documented this in everything from investment portfolios to emergency room decisions. Inaction breeds regret less than misguided action. In trading, it manifests as premature exits on winners or revenge trades on losers. Remember that soccer penalty study? Goalkeepers dove 94% of the time, slashing their save odds from 33% to 29%, just to avoid the humiliation of standing pat. Translate that to your screen. A position's up 3%, but wobbles? You sell, locking in scraps, because doing nothing while it retraces feels like negligence. Your brain doles out a dopamine hit for the decisiveness, wiring you to repeat the mistake. So, if biology and bias are stacked against us, how do we forge conviction? How do we transform I hope this works into I know this works because I've lived it? The answer isn't more rules or fancier indicators, it's ownership. Conviction isn't gifted, it's grown. And the soil? Rigorous personal backtesting, the unglamorous grind that turns abstract edges into battle-tested truths. Let's demystify backtesting first. At its core, it's replaying history with your strategy as the star. You feed in decades of price data, open, high, low, close, volume, and simulate every signal. Buys on breakouts, sells on pullbacks, stops at predefined levels. Tools like Python's Backtrader or TradingView's PineScript make it accessible, but the magic isn't the code. It's the excavation. When you backtest, you're not just crunching numbers. You're time traveling through market regimes, witnessing your system's triumphs and tribulations firsthand. Take a classic, the dual moving average crossover. Short-term 50-day simple moving average slices above the 200-day. Long signal crosses below. Short or exit. Apply this to the S&P 500 from 1950 to now, and the revelations pour out. Total return? Crushes buy and hold with lower volatility. Sharp ratio? North of 0.8, solid for a simple system. But zoom in. 1966 to 1968. A sideways grind yields 22 false signals, a 15% drawdown eating months. 1999 to 2002 dot-com hangover. Whipsaws galore, another 18% dip. Yet hold through? You ride the 2003 to 2007 bull for 100% gains, sidestep 2008's abyss better than most. Now, here's the conviction builder. You don't skim the summary stats. You dissect every trade. Trade 1,347. Entered long on tech breakout, July 1995. Drew down 8% before surging 45%. Trade 2019. Short signal amid oil spike, 2008. Stopped out at minus 2%, but the trend reversed anyway. Variance at play. By trade 5,000, you've internalized the rhythm. Losing streaks cluster and chop. Winners explode in trends. You've seen 12 trade skids that resolve into 300% runs. When live trading mirrors this, say a 10% account drawdown after oil's 2020 crash, you don't flinch. You've been here before in 1987's Black Monday Echo or 2011's Eurozone freakout. It's not if anymore, it's when, and you've mapped the exit. But backtesting alone is intellectual foreplay. True conviction blooms in the dirt of real money. Small stakes, high scrutiny. Start micro. If your system risks 1% per trade on a $100,000 account, paper trade first, then go live at 0.25%. Why? The P and L sting, however tiny, etches memory deeper than any spreadsheet. Your first rule-bound loss? It hurts, but when the next winner triples it, the lesson lands. Process over outcome. A University of Chicago study on novice investors found those who began with 20% position sizing stuck to plans 2.7 times longer than full-sizers, building scar tissue without scars. Journaling amplifies this. Not a sterile log of entries and exits, but a confessional, pre-trade conviction score, 1 to 10. Post-trade reflection. Did fear spike after lunch? Was that genius override just sleep deprivation? Over 100 trades, patterns emerge like constellations. Low conviction entries cluster post-loss. They're statistical equals to the highs, yet you sabotage them. Awareness? That's your shield. Next urge hits, you pause. Journal says this is recency bias, not revelation. Layer in safeguards, checklists, the Odysseus ropes of trading. Pre-entry? Does price break the 20-day high? Volume above average? Risk to reward at least 1 to 3? No. Stand down. For tweaks, enforce a 48-hour cool-off. Write the rationale, sleep on it, revisit. These aren't chains. They're circuit breakers, short-circuiting impulse. And underpinning it all, embracing variance. Your edge is the drift, say 52% winners at 1.5 to 1 reward to risk. Variance? The noise, the streaks that mock your math. Phil Hellmuth, poker legend, calls it the ultimate suckout. Over 10,000 hands, edge prevails. Over 10, you could bust. Annie Duke nails it in Thinking in Bets. Judge decisions, not dice rolls. A rule-following loser, victory. A rule-breaking winner, Pyrrhic. Now let's ground this in legends who lived it. Fast forward from Dennis to Paul Tudor Jones, the macro maestro who sidestepped 1987's crash like a matador. Jones didn't crystal ball it. He backtested chart patterns across 100 years, spotting eerie parallels to 1929. Conviction? Ironclad. He shorted deep, risking 4% max, holding through the 22% plunge while others vaporized. Post-crash, he quipped, losers average losers. His edge? Discipline as defense, letting offense flow from high-conviction setups. Contrast with long-term capital management's 1998 implosion. Nobel brains, models sharper than a scalpel. Early returns, 40% annualized. Then Russia defaults, correlation spike, leverage at 25 to 1. They doubled down, convinced variance would yield. It didn't. $4.6 billion gone. Why? Intellectual conviction, zero experiential depth. No backtests for black swans they'd never seen. Jones? He'd simulated crashes galore. Or Ed Sikota, the system sage who turned $5,000 into $15 million from 1972 to 1988. A 60% compound rate. His trend filters? Backtested to exhaustion on punch card computers. Drawdowns hit 30%, but he knew. Systems don't need to be changed, traders do. When cocoa trended for months in '74, he wrote it fully, rules be damned. Wait, no, rules demanded it. Others exited at 10% gains. He banked 300%. Conviction? Born of 10,000 simulated trades. Even Livermore, the boy plunger, learned late. 1907 panic. 3 million shorting unions, following his line of least resistance rule. 1929, 100 million on the short side, pyramiding winners per plan. But 1934, ruin, overtrading, ignoring stops. His fix? A notebook of max losses per session, self-imposed conviction via ritual. Linda Raschke, Futures Phenom, echoes this. Her Street Smarts co-author stresses journaling streaks. Win 5, tighten stops, lose 3, halve size. Her edge, volatility breakouts, backtested across currencies, bonds, indices. 1990s runs, she stayed in. Rules overriding the tops in itch. These aren't superhumans. They're humans who ritualized conviction. You can too. Step 1. Craft your system personally. Borrow ideas. Donkeyan channels from Dennis, Bollinger Bands for mean reversion, but hybridize. Why does it work? Exploiting herding and trends? Fading overextensions? Articulate it. Own it. Step 2. Backtest brutally. 30-plus years data, multiple assets. Metrics, CAGR above 15%, drawdown under 25%, profit factor over 1.5. Equity curve smooth? Good. Jagged, refine, but accept imperfection. Step 3, paper to micro live. Track adherence rate, aim 95%. Miss, journal why. Step 4, weekly reviews. Not P&L process fidelity. Conviction average, deviation triggers. Step 5, community without crowd. Masterminds for accountability, not advice. Share journals, gain perspective. Step 6, mindfulness toolkit. Breathwork pre-market. Visualization, replay, backtested wins. When panic hits, label it. Amygdala talking, back to checklist. But conviction isn't static. It's dynamic. Markets evolve, AI flows, retail surges via apps, annual audits, re-backtest with fresh data, tweak if edge erodes, but only per protocol. Drawdowns, their tuition. A 2023 AQR study. Top quants average 22% max drawdowns. Yours? Plan for 1.5 times historical. At 15% down, review. Still within bands? Yes, trade on. No, size down, not out. Real talk. Consistency compounds. A 10% edge, executed 90% faithfully. 18% CAGR, 70% faithful. 7%. Over 20 years, that's $1 million versus $4. The gap? Conviction. As we wrap, remember Dennis's quip. Publish rules in the Times, few follow. Why? No skin in the forge? You? Forge yours. Backtest till hands cramp. Trade small till scars form. Journal till patterns sing. Build checklists like battle plans. Embrace variance as the price of entry. Conviction isn't belief. It's evidence incarnate. Yours awaits, not in some guru's newsletter, but in the quiet hours you invest in yourself. The markets, they'll test it daily. But when you show up consistent, edge intact, you'll join the turtles who soared, the Joneses who dodged, the Seikotas who compounded legends. That's conviction. That's consistency. And that's your path to trading not as gamble, but as craft. Thanks for joining. Trade well, stay disciplined. Until next time.